Audit planning should always come first, before any audit work begins. It is the process of defining the approach, scope, and objectives of the audit. The main goal is to make sure the audit is carried out effectively and efficiently. Think of it as creating a roadmap. It helps auditors identify risks, allocate resources, and decide which procedures are needed to get accurate and reliable results. For example, in a company's IT audit, planning helps auditors focus on critical systems like payroll or financial reporting rather than spending time on low-risk areas. By planning thoroughly, auditors can streamline their work, target key risks, and provide meaningful insights to management and stakeholders. Audit planning ensures that audits are effective and focused. Let's begin by understanding audit planning stages with real-life examples. 1. Understanding the entity and environment. Learn how the organization works. For example, in auditing a hotel, auditors study front desk, booking systems, and payment processes. 2. Risk assessment. Identify high-risk areas. For example, risks like credit card fraud and online bookings are flagged. 3. Setting materiality. Decide which issues are significant. For example, a minor mismatch in housekeeping inventory is low priority compared to guest payment errors. 4. Developing an audit plan. Outline audit procedures. For example, plan focuses on online payment systems, POS operations, and payroll audits. 5. Allocating resources. Assign auditors, time, and tools. For example, one auditor focuses on POS system controls, another on payroll verification. 6. Communication with stakeholders. Discuss expectations and objectives. For example, auditors meet hotel management to confirm audit focus and timelines. 7. Finalizing the audit plan. Complete and approve the plan for execution. For example, the hotel audit plan is finalized, ready for the team to start fieldwork efficiently. When planning an IS audit, the goal is to understand the organization, identify risks, and design an effective audit approach. First, you start by learning about the organization, its mission, goals, and major activities. For example, if you're auditing a bank, you need to know its digital banking processes, security controls, and data protection practices. Next, understand the governance structure, who makes decisions, who approves policies, and how IT fits into overall business management. This helps you know who to engage and how accountability works. Then, check for changes in the business or technology environment. For instance, a company that recently migrated to the cloud may have new risks that didn't exist before. After that, review previous audit reports and working papers to see what issues were raised earlier and whether they were fixed. You'll also gather important documents, policies, procedures, system diagrams, and organizational charts. These give you a clear picture of how information flows within the company. Next, identify and assess risks to determine where to focus your audit. For example, if customer data is shared across multiple systems, data privacy controls might be a key audit area. Then, define the audit scope and objectives, what exactly you're auditing, and what results you want to achieve. Choose the right audit approach, whether you'll use interviews, document reviews, system testing, or data analytics. Finally, assign team members based on their skills and plan all logistics such as timelines, tools, and communication schedules. In short, good audit planning helps ensure efficiency, focus, and better audit results. A risk-based audit helps auditors focus their efforts on what matters most, the areas with the highest risk to the organization's objectives. Let's walk through each stage with real-life examples. Gather information and plan. At this stage, the auditor learns about the business, its processes, and potential risk areas. Example: in a telecom company, the auditor reviews how customer data is collected and stored across multiple systems to identify privacy risks before planning the audit. Obtain understanding of internal controls. The auditor identifies what controls the organization already has in place to manage these risks. Example: in a bank, the auditor examines access control policies to understand how user privileges are granted and reviewed in the core banking system. Perform compliance tests. Here, the auditor tests whether controls are working as intended. Example: in a manufacturing company, the auditor checks if production approvals above a certain amount are properly authorized according to the company's approval matrix. Perform substantive tests. The auditor examines actual data or transactions to verify accuracy and detect errors or fraud. Example: in a retail chain, the auditor analyzes sales and refund data using data analytics tools to identify unusual refund patterns that may indicate fraud. Conclude the audit. Finally, the auditor evaluates all evidence, draws conclusions, and reports findings and recommendations to management. Example: in a government agency, the audit concludes that weak password controls could expose citizen records to unauthorized access and recommends stronger authentication measures. In summary, each step builds on the previous one, from understanding risks to testing controls and verifying data, ensuring the audit is thorough, focused, and adds real value to the organization. Audit risk means the chance that an auditor gives the wrong opinion, saying everything is okay when there are actually serious problems. There are three main types of audit risk. 1. Inherent risk. This is the risk that something could go wrong just because of how a process works, even before any controls are added. Example: in a bank's loan process, there's always a risk that staff could approve fake or risky loans because large amounts of money are involved. 2. Control risk. This happens when the company's internal controls don't work properly. Example: in a hospital, if anyone can access patient files without restriction, there's a risk of privacy breaches. 3. Detection risk. This is when the auditor's tests fail to catch an existing error or weakness. Example: during a cyber audit, if the auditor only checks automated reports and skips manual reviews, some security issues may go unnoticed. When you add these together, you get the overall audit risk, the total chance that the audit misses something important. The goal of every good auditor is to keep that overall risk as low as possible. An IS auditor needs a strong understanding of audit risk when planning and executing an audit, because relying on samples rather than reviewing every transaction always carries some uncertainty. In practice, this means that even if the sampled items appear correct, there is still a possibility that undetected errors exist in the remaining population. For example, during a bank audit, the auditor may review a sample of loan transactions to verify compliance with approval policies. If only compliant transactions appear in the sample, it might suggest strong controls. However, there could still be untested loans processed outside policy that remain undetected, creating sampling risk. Good statistical sampling techniques and strong quality assurance processes help reduce this detection risk to an acceptable level, but they can never eliminate it completely. A practical case is an e-commerce company where an IS auditor samples user access logs to confirm that terminated employees no longer have system access. If the sample shows proper deactivation, management may assume controls are effective, but a few missed terminations outside the sample could still allow unauthorized access, turning into a serious security risk. When evaluating internal controls, auditors must also understand that individual errors may appear insignificant, yet multiple small issues combined can become materially important. Consider a payroll system where a minor rounding error occurs during salary calculations. One instance may seem harmless, but if it happens across thousands of employees every month, the financial impact could become huge and even lead to regulatory issues. Similarly, if an insurance company's claims processing system occasionally skips a validation check, one skipped claim may not matter, but repeated occurrences could lead to significant fraudulent payouts. In summary, statistical sampling risk simply means that conclusions drawn from a sample may not perfectly represent the entire population, and small, undetected errors can accumulate into major issues. Real-life auditing requires auditors to plan carefully, use appropriate sampling techniques, remain professionally skeptical, and always consider the potential cumulative effect of undetected errors. Risk assessment is simply the process of finding out what could go wrong, how likely it is to happen, and what the impact would be. It helps organizations focus on the most serious risks that could stop them from reaching their goals. For example, in a bank, risk assessment might look at the chance of a cyber attack on online banking systems and how it could affect customers' access or data security. An IS auditor should understand the organization's risk assessment method, how risks are identified, scored, and managed. This helps the auditor know whether risks are being handled properly. Risk assessment isn't a one-time thing. It should be done regularly, like when new systems are launched, when regulations change, or when new threats appear. The scope can vary. It might cover the entire organization, a specific department, or just one system, such as payroll or cloud storage. Finally, risk assessment must use clear criteria to decide if a risk is acceptable or if action is needed, based on the organization's risk appetite. In short, effective risk assessment keeps the business alert, focused, and ready for change. Risk assessment is a key part of an IS auditor's work. It helps the auditor understand where the biggest risks to information systems are and how to plan the audit effectively. First, it helps identify risks and threats to information systems. For example, in a bank, the auditor may find that customer data is exposed to risk because of weak password policies or outdated antivirus protection. Second, it helps the auditor evaluate controls during audit planning. If a retail company relies heavily on online payments, the auditor will focus more on testing payment security and data encryption controls. Third, risk assessment helps set clear audit objectives. For instance, if a hospital faces data privacy risks, the audit objective may focus on checking compliance with health data protection laws. Finally, it supports risk-based audit decisions, ensuring that audit time and effort are spent on areas that matter most. This way, auditors can give management better assurance and practical recommendations. In short, risk assessment makes audits smarter, focused, and more effective. Risk assessment follows a series of steps to help organizations identify and manage risks to their information systems effectively. Let's go through them with real-life examples. 1. Prepare for assessment. This is where the auditor defines what systems or areas will be reviewed, who will be involved, and what methods will be used. Example: in a bank, the IT risk team decides to assess online banking security and gathers policies, user access logs, and incident reports before starting. 2. Conduct assessment. Identify threat sources and events. The auditor identifies potential threats that could harm the system. Example: in a telecom company, threats may include cyber attacks, insider misuse, or service outages caused by network failures. 3. Identify vulnerabilities and predisposing conditions. This step focuses on weaknesses that make systems more likely to be affected by threats. Example: in a hospital, outdated antivirus software and shared user accounts create vulnerabilities that make it easier for malware to spread. 4. Determine likelihood of occurrence. Here, the auditor estimates how likely it is that a threat will exploit a vulnerability. Example: in a university, phishing attacks may be rated highly likely because staff frequently receive suspicious emails and security awareness is low. 5. Determine likelihood of impact. The auditor evaluates how severe the damage would be if the risk happened. Example: in a retail company, a data breach could lead to customer trust loss, legal penalties, and major financial loss, a high-impact scenario. 6. Determine risk. Combining likelihood and impact gives the overall risk level: low, medium, or high. Example: for a government agency, the risk of losing citizen data due to poor backup systems might be rated high. 7. communicate results. Finally, the auditor reports findings and recommendations to management. Example: in an insurance firm, the audit report might recommend stronger password policies and regular data backups to reduce high-risk areas. In short, these steps help the IS auditor move from identifying risks to clearly explaining their impact, so management can act before problems occur. When risks are identified, an organization must decide how to handle them. These are the four main risk treatment options. Risk mitigation: take actions to reduce the likelihood or impact of the risk. Example: a bank installs firewalls, updates antivirus software, and trains staff on phishing awareness to reduce cyber attack risk. Risk acceptance: decide to live with the risk because it's low or the cost of fixing it is too high. Example: a small business accepts the minor risk of short internet downtime since the cost of a backup network link is not justified. Risk avoidance: eliminate the activity or process that causes the risk. Example: a university decides not to store student payment details locally and uses a secure third-party payment gateway instead. Risk sharing: transfer. Pass the risk to another party, often through insurance or outsourcing. Example: a hotel transfers financial risk by purchasing cybersecurity insurance and outsourcing online payment processing to a secure vendor. The risk management process helps organizations identify, assess, and manage risks that can stop them from meeting their goals. Identify business objectives, BOs. The first step is to understand what the organization wants to achieve. Example: a bank's main goal is to provide secure and reliable online banking services to customers. Identify information assets supporting BOs. Next, identify the key systems and data that help achieve these goals. Example: the bank's online banking application, customer database, and transaction servers are important assets. Perform risk assessment. Here, the organization looks for possible threats, weaknesses, and risks that could harm these assets. Example: the bank identifies risks such as cyber attacks, phishing, insider fraud, and system failures. Perform risk mitigation. This step involves putting controls or safeguards in place to reduce the likelihood or impact of risks. Example: the bank implements firewalls, strong password policies, two-factor authentication, and regular system backups. Perform risk treatment. After reducing risks, management decides what to do with the remaining ones. They can accept, avoid, or transfer them. Example: the bank may transfer some financial risk by buying cybersecurity insurance. Perform periodic risk revaluation. Finally, risks should be reviewed regularly to identify new threats or changes. Example: after system upgrades or regulatory changes, the bank reassesses its risks to stay protected. In summary, the risk management process helps organizations protect their assets, reduce threats, and make sure they can meet their goals safely and effectively. An IS auditor can use qualitative or quantitative risk assessment methods depending on what part of IT is being reviewed. In simple terms, this means deciding whether to use judgment-based methods, like ranking risks as high, medium, or low, or number-based methods, like calculating financial loss or probability. Using risk assessment to plan audits has several benefits. It helps the auditor focus on the most critical and risky areas, use limited resources more efficiently, and make sure that important information from management, IT teams, and business owners is considered in planning. For example, in a bank, the IS auditor might identify that the internet banking system poses higher risk than the HR system because it handles customer money and online transactions. So the audit plan will focus more effort there. In a telecom company, auditors might prioritize systems handling customer billing data after noticing frequent customer complaints or system outages, showing how risk assessment directly influences where the audit team spends its time. Finally, a good risk-based audit plan helps align audit activities with business goals, ensuring that the audit function adds real value, not just ticking boxes. When performing IS audits, there are two key legal concerns to keep in mind. Laws that affect the audit itself, for example, data privacy laws that limit what information auditors can access, laws that affect the organization being audited, its systems, and data, such as data protection, cybersecurity, or financial reporting laws. As IS auditors, we're expected to identify which laws and regulations apply to the organization or industry we're auditing. For instance, if you're auditing a bank, you must consider CBN regulations, NDPA, Nigeria Data Protection Act, and anti-money laundering laws. Next, auditors should confirm that these laws are reflected in company policies and procedures. For example, when reviewing an insurance company's IT policy, you might check if customer data handling aligns with NDPA requirements. Auditors should also test compliance, ensuring systems, reports, and controls follow these laws. Finally, check that contracts with vendors or service providers include legal clauses on data protection and confidentiality. For example, if a company outsources data storage to a cloud provider, you must verify that the service contract complies with NDPA and includes clear non-disclosure and data return provisions. This way, the IS auditor ensures both the audit process and the organization stay legally compliant.